It is summer. It is just glorious outside, and I am loving life right now. I hope you are well. So today, I want to take a little break from the entrepreneurship series I have been loving and bringing to you to bring you a tax-focused episode. So I want to drop in here to talk about medical expenses. I've had some questions from listeners about medical expenses. I know they kind of sit in that zone of like, I sort of vaguely think these might be deductible, but my accountant never asked me about them. What's the deal, right? So this episode is one that I hope you can save. You can share with your friend who just had surgery or is going through in vitro fertilization or some other expensive medical part of their life right now. Please share this episode with them. It is meant to give you the tools you need to determine if and when you are having a year where it's worth tracking your medical expenses, like when you actually get to take your medical deductions. And you're going to learn very quickly, as I explain it to you, why people feel so confused about tax deductible medical expenses. All right, so let's just jump right in. Okay, so the very first thing you have to understand about medical deductions, your medical expense deduction, is that it is one of the itemized deductions. Okay. Now, for many of you listening, you need a review of what itemized deductions are. And I just want to refer you to my episode on itemized versus business deductions. If you are feeling confused, if you think those are the same thing, they're not. So I want to just make clear, I made a whole podcast episode about that. I will link it in the show notes about how your itemized deductions have absolutely nothing to do with your business deductions. And if you have a Schedule C, if you work for yourself, you absolutely are entitled to all your business deductions, whether you itemize or not. Okay. Itemizing is a separate thing. So first we'll need to explain what itemizing is, because you're only going to get medical deduction expenses if you itemize. All right. Okay, so first we'll explain that, and then we'll get into some detail about when the numbers break in your favor and when it's going to be worth tracking your medical expenses. The short, quick version, if you just want to know if this episode is for you or not right away, the quick version is only in a year when your medical expenses are very, very, very high. And if they are, exceedingly, outrageously high, yeah, you're probably going to get them at that point, and I'll tell you exactly how. But if they're not, you might be in the more borderline zone. Okay. So again, I'll give you all the tools you'll need to know if this counts for you, and I'll give you a quick little review list at the end, so you can be sure that after you've learned those sort of harder parts, that you've got your sort of 5-point checklist at the end. Okay. That's what's in store for you today on today's episode. And again, if you have a friend going through a medically difficult time right now, please share this episode with them, because that is who is really going to benefit the most. Okay, so itemized deductions versus your business deductions. If you listen to this show, which is geared towards self-employed people, you almost certainly have business deductions and you get them. I want to make it very clear to you that business deductions are not itemized deductions. Business deductions go on your Schedule C with your business income and your business expenses, right? Business expenses go on a Schedule C, all right? Itemized deductions have a totally different schedule. They go on the Schedule A on your 1040, okay? Please notice, these are two different schedules. They are two different things. They're independent. They're unrelated. Some of you know this and you're like, why is she saying this over and over? The reason I say this over and over is I see people get this wrong all the time. And the tragic thing that I see happen is that an accountant will say to their client, oh, you don't itemize. And they think you know what that means. And I have seen people who don't know what that means, and there are many, who then throw out their business receipts, thinking that what the accountant meant was that they don't get to take business deductions. An accountant never means that. That's not what they're saying. They're saying you don't itemize. In other words, you don't have itemizable deductions. Okay, so let's clarify what it means to have itemized deductions. So Here's the shortest and most concise way I know how to explain it. Every US taxpayer gets an initial chunk of their income tax-free, okay? Now, you have two options. You can have a fixed amount tax-free, and we call that fixed amount the standard deduction, or you can have a variable amount tax-free. The variable amount we call itemized deductions, okay? So there is an either or, an if then, and the either or is you either itemize or you take the standard deduction. That is a one-to-one. You either do one or you do the other. You cannot do both. That's the thing. If your accountant says you don't itemize, what they mean is you take the standard deduction, okay? Quick takeaway for you on this. You can check your own 1040, right? The first 2 pages of your tax form called the 1040. And on line 12, it's going to tell you if you take the standard deduction or if you itemize. Now, it doesn't tell you in a super clear way, but what it does is it has, you'll see if you're looking at this actual tax document, on line 12, you'll see there's a little pullout on the side that explains your standard deduction amounts for that year, okay? Now, I'm going to read it for you. I have a 2022 tax return here in front of me. That's the most recent one that is available because we're still in tax year 2022, even though it's even though it's 2023, because taxes are retroactive. So I'll read it to you. All right. This is what the standard deduction is for 2022. So if you haven't filed your taxes yet, if you're on extension, this is what you're getting for the year. If you're single or married filing separately, your standard deduction is $12,950. In other words, your tax-free chunk is $12,950. If you're married filing jointly or you're a qualified surviving spouse, your standard deduction for 2022 is $25,900. If you're a head of household, which generally means that you're single, but you have a dependent or multiple, then your standard deduction is $19,400. Okay. So those are the standard deduction amounts. That's the tax-free amount by default if you don't itemize. Okay. I want you to be aware that 90% of US taxpayers take the standard deduction. Only 10% itemize. So chances are good that you don't itemize. You take the standard deduction. But in other words, those numbers I just listed to you, and you can refer back to them by printing a blank 1040 off the IRS website, like I just did, or you can look at your own tax return, and you'll see line 12. It'll show you those standard deduction amounts. Now, these change every year. They increase a little bit each year. So if you're, looking at a 2023 tax return, 2024 tax return, if you're listening to this episode years in the future, these amounts will be slightly higher, but they'll be around that amount. So, in your head, around $13,000 if you're single, around double that if you are married filing jointly, and head of household is kind of splitting the difference in between those two numbers, right? That is your baseline in your head amount for what your standard deduction is. You can always look this up online. It's a highly Googleable item, okay? So that's a standard deduction. Now, if you have itemizable deductions that are greater than the standard deduction amount, then you're going to itemize. So you get to choose whether you itemize or take the standard deduction. And the choice is simple. You take the bigger number, right? You take the bigger tax-free number. You get to take either one. So it's sort of a no-brainer. Okay. So you're only going to itemize if your itemizable deductions are higher than those amounts I just listed, higher than the standard deduction. Okay. So what are itemized deductions? The big ones are charitable contributions, state and local taxes capped at $10,000, used to be infinite, but the Republican tax law changes of 2018, they capped it at $10,000. So charitable, state and local taxes capped at $10,000, medical expenses that exceed 7.5% of your adjusted gross income. Okay. And we'll get into all of that. That's what this episode is about. And the last one is mortgage interest. Okay. Those four things are your chief itemizable deductions. Okay. Now, again, most US taxpayers, 90% of US taxpayers do not itemize, do not have a number there that is higher than the standard deduction. You can do the math yourself. Do you have mortgage interest? Do you have state and local tax payments? Do you have exceedingly high medical expenses? Or are you donating so much to charity that you itemize? If you do, then you will list those things on a Schedule A, which is where you put your itemized deductions, and you will get to take that bigger amount, no matter how big it is, actually. Okay, so you'll probably notice it's going to tend to be someone who owns a home who itemizes, right? Because mortgage interest. So renters typically do not itemize. I've only seen a few renters itemize ever in my tax practice history. Those people were always living in one of the most expensive cities. So those people were only ever in New York City or San Francisco. And charitable contributions. If you donate enough money for a hospital wing, you are going to itemize. In other words, because you do get this incredibly high deduction for your charitable contributions. So you will note that itemizing tends to be something for the well-heeled, right? The 1% all itemize, all right? Somebody show me an example where that's not true. I'll be very curious to know. But in general, the 1% itemize. Also, the 2%, maybe the 3%. But if you're listening to this, you might itemize, but you probably don't, okay? So if you have those expenses that I listed, charitable, state and local taxes capped at $10,000, mortgage interest, or medical expenses that exceed 7.5% of your adjusted gross income, you add those four things together, right? So you can put those all into the same bucket, the itemized bucket. And if that bucket outweighs the standard deduction bucket, then you will itemize, okay? So please understand, if you're single, you need almost $13,000 worth of those types of expenses to even bother itemizing, right? To even bother tracking things like your charitable contributions or your medical expenses, okay? Now, I do recommend that you have a folder, like hanging file folder, and also a folder in your inbox. If you do make charitable contributions and you do have medical expenses, I mean, who doesn't have medical expenses? And do save the receipts, toss them in there, but don't bother sorting them. Don't bother tracking them until you hit a certain threshold. Okay, that's my recommendation to you. Have the receipts so that if you do get in a car accident or suddenly decide you're going to do in vitro fertilization treatments, now you have the receipts from the earlier part of the year and you can use those. Okay, that's my recommendation to you. But I wouldn't bother spending any time sorting them or doing bookkeeping with them, because the odds are very high that you're not going to get anything out of them. So in other words, what I want you to do is know your baseline, okay? So I want you to know if in general you take the standard deduction, which is probably the case, or if you don't. If you do itemize already, then it's a good idea to track your medical expenses because you're more likely to be able to take them, okay? And again, you can always look at line 12 of a 1040, which you can just pull off the IRS website, and you can remind yourself what those standard deduction limits are, so you know how high your expenses have to get on the itemized side in order to be an itemizer. All right, now let's dig in more specifically to the medical piece, okay? So you have to keep in mind that these are only going to count once that bucket of itemizable deductions exceeds that standard deduction. I know I sound like a broken record, but people really do not know this. And so I'm really trying to make it extra clear and repeat it 1,000 times, okay? Okay, so the rule for medical expense deductions is you only get to start deducting medical expenses once they exceed 7.5% of your adjusted gross income. All right, so let's talk about what that means. First of all, what's your adjusted gross income? Your adjusted gross income is something you can find on line 11 of your 1040, okay? Again, you can go ahead and print a blank 1040 tax form off the IRS website, and you can just look at line 11. If you're looking at your last tax return, look at line 11, and that will show you your adjusted gross income. This is one of those baseline numbers that's very important to know because a lot of things in your taxes are calculated off of that number. Here, I'm giving you the example of your medical expenses, which are calculated off of that number. Okay, so it's good to know your adjusted gross income, and it's good to know whether you itemize or take the standard deduction. These are two key pieces of knowledge about your own tax return, your own tax situation that help you make decisions year round. So in general, just that's a good piece of, that's a good takeaway for you from today. And they're side by side on your tax return. Line 11 is your AGI, and line 12 tells you whether you take the standard deduction or you itemize, okay? Okay, so you can see on line 11 what your AGI was for the prior year. Now, of course, AGI is a moving target, right? Because your income is not going to be exactly the same every year, right? But in general, we tend to base things off of the prior year, assuming that your years will tend to look similar to each other, okay? So you'll look at line 11, your AGI from last year, and you're going to calculate what 7.5% of that number is. And that is your floor for your medical expense deduction, okay? Let me illustrate with an example. So let's say your AGI, I'm going to use nice, easy round numbers for you. Let's say your AGI is $100,000, okay? Your adjusted gross income is $100,000. 7.5% of $100,000 is $7,500. What that means is I spend money on medical things, qualified medical expenses, but I only start getting to deduct them off my tax return once they are greater than $7,500. In other words, my $7,500 first dollar is my first deductible dollar of medical expenses, okay? So if I spend $8,000 on medical items and my AGI is $100,000, I get a $500 medical deduction, okay? So you can start to see where you get you start to get a lot of your deduction proportionally only when that medical expense for the year is pretty enormous, okay? There are people who have enormous medical expenses, and if you are in that boat, you probably will itemize, and the reason you will itemize is probably because of those enormous medical deductions, medical expenses, all right? So it's very rare that a young, healthy person or even a young, healthy family gets a medical deduction even at all. It's often not worth even tracking because you're so far from that number. But I do recommend that all of you go and do that mental exercise. See if you take the standard deduction or you itemize now, like know that piece of information, and also do a calculation. What is 7.5% of line 11 on my tax return, my adjusted gross income, so that you know kind of at what point you would get any credit for your medical deductions. Now, I want to remind you about itemizing. Again, I was giving that example of someone with $100,000 AGI who had $8,000 in medical expenses. So that person has a $500 worth of deductible medical expenses, right? $500 that exceeds 7.5% of that AGI. Now, $500, remember, even though that is now a deductible medical expense, $500 is not going to push me into being a person who itemizes, right? So only if in combination with my mortgage interest, charitable contributions, and state and local taxes capped at $10,000, only if in combination all those numbers exceed the standard deduction am I going to itemize and therefore get any credit for that medical expense, okay? However, if I had a health disaster, if I had, like massive psychiatric treatment and maybe a hospitalization, et cetera, right? Or maybe I had round after round of in vitro fertilization, a major surgery, hospitalization, things like that, where your medical expenses are like, you know, $30,000, $40,000, $50,000. Now you don't get that first 7.5% of your AGI worth of those expenses, but you're going to get the bulk of those medical expenses. And that number alone will probably be greater than the standard deduction amount. And therefore, a super high medical expense is worth tracking, and you'll get to deduct most of it on your taxes. Okay. So in a disaster year or in an exceedingly high medical expense year, then it is very worth tracking. Okay. So that's kind of the baseline. And I hope that this has helped you sort of break down how to do the math about how to know when it's worth you tracking or not. Okay. So I'll give you an example of a client that I had, a tax client who had a rare disease and decided to go travel to Germany to a specific doctor who treated this very rare disease. Now, for this client, you know, he was able to deduct travel to that doctor for this specific disease. So he was able to deduct his airfare, his hotel to stay in Germany for this treatment, and of course, all the expenses related to the treatment itself. Okay. So this client in particular had around $50,000 that year in medical expenses. And so that was a person that, even though he rented, right, even though he wouldn't on a normal year, he would have just taken the standard deduction. In this year where he spent $50,000 in unreimbursed medical expenses, he did itemize, and he did get the bulk of that $50,000 as a deduction. Okay. So I'm going to talk to you about my takeaways. These are the things that I want you to take away. Here's your checklist as you consider whether it's worth it for you to even track your stuff or not. Okay. So here's a little checklist for you. Number one, know your AGI. Okay. So just remember, line 11 of last year's tax return will tell you what your AGI is. 7.5% of that number is the amount at which, once you exceed that amount, those become deductible medical expense dollars. Remember, they still have to go into the bucket of itemized deductions, and you still have to exceed the standard deduction. But knowing that baseline number, what is 7.5% of your AGI, that's your sort of baseline of when it starts being worth even tracking your medical expenses. Okay. It's a good idea to know when you have a heavy medical expense year coming up. You can't always know. Of course, if you get in a car accident, you don't know that in advance, right? Sometimes you are hospitalized, you know, in an emergency, unpredictable way, right? But sometimes you do know, right? If you are planning a surgery where you can select the timeline, for example, you know, there are some things, if you're doing in vitro fertilization treatments, for example, sometimes you have some power over the timeline. Okay. So have a sense of when you have a heavy medical expense year coming up. And in general, you're definitely going to want to be setting aside all your receipts for that. A couple other things to note is that, of course, if you're in a family, if you're married filing jointly, if you have dependents, then all of the medical expenses for the family go into this bucket together. So don't forget that it's not just you, but it's anybody in your family whose medical expenses count. Let me also just spend a quick moment talking about what medical expenses are deductible. I'm including a list in the show notes here today. So this whole episode has kind of everything that you need. But in general, you are allowed to deduct medical expenses that are unreimbursed. So if you get reimbursed, you didn't pay it, right? Ultimately. And if you didn't pay it, you don't get to deduct it. Okay. So unreimbursed medical expenses do get to come out. And the deductible medical expenses are very generous. So again, take a look at the document I'm including in the show notes from the IRS, but I'll just read off a couple things that are on it that might not be totally intuitive to you. So acupuncture, chiropractic services for medical care, contact lenses, addiction treatment, birth control, Braille books and periodicals if you're blind or visually impaired, breast reconstruction surgery following a mastectomy for cancer. Cosmetic surgery is not deductible, but if it's necessary to improve a deformity related to a congenital abnormality or an accident or a disease, then it is deductible. Diagnostic devices are deductible. Also things, so vague and general expenses for your health are not deductible, but if it is specifically prescribed by a doctor for a specific medical condition, then that's sort of the magic sauce that makes it deductible. So diet, food, exercise programs, if they are recommended by a doctor to treat a specific medical condition, then they are deductible. So for example, I can't just decide like, oh, my gym membership, like that, I don't get to deduct that, or the cost of my dance classes. I'm sort of obsessed with a hip hop dance class. My dance class is not deductible because it wasn't diagnosed to alleviate anything specific, right? Even though it brings me health and joy. However, when I was having knee problems from my dance class and I talked to my doctor about it and she recommended some physical therapy, that was a specific recommendation. And so my PT, then I got to deduct. Okay, so that became deductible at that point. Fertility treatments, false teeth, glasses, gender affirming care, such as hormone therapy and surgery for transgender individuals, guide dog or animal services for people with low vision or hearing needs, health, dental, and vision insurance premiums, hearing aids, home improvements, if the main purpose of those is for medical care, for receiving medical care. If you have to widen a part of your house or install an elevator because you're in a wheelchair, for example, that home renovation is deductible as a medical expense. Obviously, if you're going to home renovate, you're very likely to cross into those deductions being deductible for you that year. Okay, so that's just, there's a huge, huge range of things that are medically deductible. But I hope that that sample kind of got you a sense of it. Also, if you see a psychiatrist, psychiatric care, going to your therapist, that is also deductible. So, all right. So I hope that has been helpful for you. I know it's really confusing, just itemized deductions, even though it's like kind of one of the baseline building blocks of your tax return. I know they can still feel very confusing. So I hope that even just reminding yourself or learning for the first time the difference between itemizing and taking the standard deduction and knowing how to find out that piece of information on line 12 of your tax return, I hope that has been valuable for you. In general, I recommend that you save your medical receipts always, but don't bother sorting them or going through them or like putting them into any kind of spreadsheet until you cross a line of 7.5% of your adjusted gross income for the year. Only at that point would I actually go back to the receipts and start trying to list out all of them for my taxes. All right. Wonderful. I hope this has been super helpful for you. I want you to know if you are listening to this the day that the episode comes out or the day, a couple days after, I am going to host again my class on how to thrive in a recession when you're self-employed, and it is not too late to register. So if you're listening to this, if you've been feeling kind of the economic jitters or just that like, ooh, aren't we in a recession? How will this affect me? How will this affect my business? I know that can feel really scary to people. It feels scary to me. And so I have developed a class about things you should know in your personal finances when we go into a recessionary period. Whether or not it's technically a recession doesn't actually matter. How to adjust your tax payments in a recession if your income drops, for example, how to adjust your estimated quarterly tax payments so that you have cash to pay for your life. And there's a lot of really good news in my class. I talk a lot about the opportunities, the hidden opportunities that are hiding inside of a recession. And I think that's really important to know. Recessions have a sort of cleansing function in our economy. They tend to knock down a lot of the overpriced products and businesses with incredibly high margins. They tend to knock over those businesses who aren't offering a lot of value to people. But businesses that are operating and delivering really good value will tend to stay in business and actually pull way, way ahead. So there's really good news. If you're running a business that you feel proud of and you're delivering a lot of value to your clients, you have a lot of opportunity inside a recession. So I'll be talking about investing. I'll be talking about specific things you can do inside your business and also personal finance moves you want to be making when it comes to a recession. All right. So this class is really meant to hold that emotional space as we get into a fearful time, and really help you know that you're doing the right things and set yourself up to survive and to thrive. And it is possible for a recession to be one of the best things that's ever happened to your business, even though that might not feel intuitive. So you can sign up for this class. This is a repeat of the class I offered a month ago. If you went to that, this is the same class again, but I decided to offer it one more time because it was very popular and I'm not sure I advertised it well enough. So you can go to go.sunlighttax.com/recession to sign up for the class. You'll get some reminder emails and I will see you in class. So that's go.sunlighttax.com/recession to sign up for that free class. It'll be really awesome. People have been loving the class. I've got lots of really good feedback about it. So, and also sign up even if you can't make the time, because I'll be sending the recording out afterwards. All right. So I hope you enjoy that. I will leave that link in the show notes. And again, if this episode about medical expenses has helped you, or if you have a friend who's been having a rough year medically, has any of these medical expenses, please send this episode to them. I would be so grateful. I think, I made it to benefit that person out there who's having that really hard medical year. So please send this episode to that person if you know that person. All right. This doesn't matter if they're self-employed or not. This is really something that applies to all taxpayers. All right. Thanks so much for joining me, everybody. It's been my pleasure. And as always, if you have any questions or thoughts about this episode, you can always let me know at Sunlight Tax on Instagram. Just send me a message there. All right. I'll see you on the next one. Bye.